$2 trillion is pouring into AI, and it could either send the stock market soaring or bury it completely. And the scary part, the crash looks way more likely, and it could affect you directly. Josh here, and on today's episode of the Infographic Show, we're revealing what happens to the economy if the AI bubble bursts. According to most recent estimates from Gallup, 62% of Americans owned stocks in 2025, the highest rate in 2 decades. That includes retirement accounts, 401ks, and index funds. After the dot-com crash and the 2008 real estate meltdown, people were trained to believe that passive investing in the S&P 500 is the safest long-term strategy. Even after those crashes, the Nasdaq eventually rebounded, led by a new set of tangible goods and services, which we'll touch on later. Today, investing in the S&P 500 essentially means betting heavily on a handful of AI-driven companies to keep growing forever. Right now, 52% of the S&P 500 is concentrated in just 20 companies, most of them riding the AI wave. When you contribute to your 401k this month, a chunk of your money goes straight into NVIDIA, Microsoft, and Alphabet's AI ambitions, whether you like it or not. The scale of it is potentially devastating. A BlackRock and Commonwealth survey found that roughly 54% of Americans earning between $30,000 and $80,000 have investment accounts. These are not hedge fund managers who can weather a crash. These are teachers, nurses, and warehouse workers. Then there are the pension funds, the retirement systems for teachers, city workers, and public employees. Billions of dollars from those funds are pouring into the same AI-heavy stocks. They're some of the most dangerous fault lines in the next market correction. The gains went to the companies making the bets. If it all goes wrong, it won't touch them. It'll land on the people least able to absorb it. The human cost gets lost in the trillion-dollar figures. When you spend enough time looking at stories about the economy, markets, and where everything might be headed, it's easy to get stuck in this mindset where you feel like you need to have everything figured out immediately. Like if you can't solve the whole picture at once, you just stay stressed, overthink it, and you don't know where to start. And I think that is something a lot of people can relate to because life is like that too. Sometimes the pressure isn't one huge dramatic thing, it's just the constant weight of uncertainty, stress, and feeling like you're supposed to have all the answers right now. That's one reason therapy can be so valuable. It gives you space to slow down, sort through what you're feeling, and take one step at a time instead of treating everything like it has to be all or nothing. Therapy has helped me take what feels like a huge problem and break it down into something a lot more manageable. It's helped me focus on what I can do right now and make things less overwhelming. And that's why I'm glad BetterHelp is sponsoring this video. BetterHelp makes starting therapy easier. You can take a quick quiz and get matched with a licensed therapist. And if it doesn't feel like the right fit, you can switch anytime at no extra cost. You can also communicate in whatever feels the most comfortable for you, whether that's phone, video, or text. Sometimes progress isn't about fixing everything all at once. Sometimes it's just about having the support and perspective to move forward a little more clearly. So if you've been thinking about trying therapy, click the link in the description or go to betterhelp.com/infographics to get 10% off your first month of therapy. So if the underlying economics are this shaky, then what is keeping the AI boom alive? The answer lies in circular funding, and once you see it, you can't look away. Want to stay ahead of the AI boom and the risks it brings? Like, share, and subscribe. We've got much more on the AI revolution and what it means for you. NVIDIA invested $30 billion into OpenAI in 2026. OpenAI then uses those funds to buy NVIDIA's chips. The money goes out and comes right back in again. NVIDIA's revenue looks strong. OpenAI looks well capitalized with a large investor behind it. Everyone's valuation goes up. None of this required a single real customer to pay for a product. Then there's Microsoft. The company invested $13 billion into OpenAI, but a significant portion of that came in the form of Azure cloud credits, not cash. OpenAI could record it as capital raised, but you can't pay your employees with cloud credits. You can't cover office leases or legal bills. What looked like a $10 billion investment was a $10 billion gift card that can only be spent back at Microsoft's own store. Very little cash actually changed hands. OpenAI has a deal where it sends back 75% of its earnings to Microsoft to recoup the investment. Once that's cleared, it drops to 49%. Microsoft is basically just sending money in and then returning it to itself. But it goes deeper than that. OpenAI holds stakes in AMD, while NVIDIA owns part of CoreWeave, a cloud provider that Microsoft relies heavily on. Microsoft, in turn, is a major NVIDIA customer. Oracle even signed a multi-billion-dollar deal with OpenAI. Essentially, these venture-backed giants are buying services from each other. It is a web of circular funding that you can't ignore. Meta pushed it to the extreme in late October 2025. It sold $30 billion in corporate bonds while securing another $30 billion in off-balance sheet debt through a Morgan Stanley-structured joint venture. It was designed to hide the true scale of its liabilities. Why is this a problem? Well, with circular financing, there's no actual money involved. It's just a bunch of IOUs that the owners hope never get checked. Revenue looks impressive right up until the moment that everyone tries to cash in at the same time. To drive the point home, Morgan Stanley estimates that global spending on data centers between 2025 and 2028 will go up to $3 trillion. $800 billion of that is financed by private credit. This is not earnings, but debt raised by investors made by other companies. So, with all this support, you would think AI companies like OpenAI would be swimming in cash, but the financials tell a very different story. OpenAI reported a $20 billion revenue run rate in 2025, but the costs to power its models were so astronomical that it burned through nearly all of it, resulting in a staggering $17 billion net loss. In November 2025, the company confirmed it expected to report annual losses through 2028, including $74 billion in operating losses in 2028 alone. Yet, the valuations hold, because enough money for now keeps flowing in. That brings us to the most damning data point of all. In August 2025, a report was published that should have been front-page news everywhere. It studied $30 to $40 billion in enterprise investment into generative AI across hundreds of organizations. The finding was that 95% of those organizations reported zero measurable return on investment. U.S. Census Bureau data also shows that AI adoption by large companies may have already peaked and began declining in 2025. What companies are actually doing is using AI tools occasionally, reviewing their outputs manually, and then implementing the results by hand. It speeds something up, but a human still does the work. It creates a trap for AI companies. The more people that use the product, the more money the company loses. So what's the theory of how this becomes sustainable? The honest answer is that AI companies are betting on a future that doesn't exist yet. They're asking investors, users, and the economy to fund that bet today. The logic is that compute costs will fall and efficiency will improve. This will lead to better costs for the consumer. At some future point, revenue will outpace the burn rate. After all, despite the dot-com crash, the internet eventually delivered on its promises. Some of those companies went on to become major players that we see in the AI game today. But that framing hides something. Harvard economist Jason Furman estimated that AI-related infrastructure investment accounted for roughly 92% of U.S. GDP growth in the first half of 2025. Strip that out and the country would have grown just 0.1% during that period. That means the American economy has become dependent on a spending spree that has no proven revenue model behind it. The AI bubble hasn't burst, but the structure underneath looks familiar. So what happens when it pops? Investment firm Oliver Wyman has modeled two scenarios. Neither is good. The first is the equity scenario, where a shift in investor confidence triggers a broad correction in AI-related stocks. Given that AI names account for roughly 75% of S&P 500 returns, a sector-wide sell-off would crater the broader index. If we see failures in line with the dot-com collapse, this could wipe out more than $20 trillion in wealth for American households and $15 trillion for foreign investors. At today's valuations, the total figure could exceed $33 trillion, surpassing annual U.S. GDP. In the second scenario, the debt dimension makes everything worse. Unlike the dot-com era, which was primarily an equity story, the AI build-out is increasingly debt-financed. If that credit structure unravels, then we could see something that looks more like the crash of 2008. Smaller banks that have lent heavily to AI companies or count them as key depositors would be out immediately. Social media could accelerate bank runs from days to hours. Michael Burry, the investor who famously bet against the housing market before 2008, has warned that the government will pull out all the stops to save the AI bubble. But unlike 2008, he argues the financial hole may simply be too big to fill. The numbers are too big to ignore, but this is nothing compared to the human cost of the crash. We might see more than 2.5 million jobs in the US at risk from a full burst scenario. While top companies are trading money between one another, they still need to have the chips and the electricity flowing in. So the AI giants have made enormous binding commitments to the physical energy infrastructure of the US. Microsoft signed a power purchase agreement to reopen the 3 Mile Island nuclear plant in Pennsylvania. Google signed one to restart the Duane Arnold Energy Center in Iowa. OpenAI and Oracle are installing more than a gigawatt of natural gas turbines at their Project Stargate campus in Abilene, Texas. Meta's Prometheus data center in Ohio is set to come online in 2026 and runs on 1 gigawatt of power. The much larger Hyperion data center in Louisiana will draw 5 gigawatts when it becomes operational in 2030. It will have enough electricity to run twice the entire city of New Orleans. 42 states have either no sales tax or offer full or partial exemptions for data centers. In the 16 states that publicly report this, the foregone revenue over 5 years totals $6 billion. That is $6 billion not going to schools, infrastructure, or local services. Instead, it is pouring into data centers that are supposed to power the next artificial general intelligence. People are already paying for this build-out before the bubble bursts. If the data centers go dark, those renewed power plants don't just disappear, neither do the contracts that make them. What does disappear is the revenue that was supposed to justify them. The private companies that took the risk get bailed out. The public picks up the bill through higher electricity costs, potentially for decades. When the internet bubble burst in 2000, it left behind fiber optic cables, which lasted for decades and are still connecting the world. Newcomers could buy them at bargain bin prices and build the infrastructure of the next generation on top of them. Google, YouTube, and Netflix all ran on cheap fiber that dot-com companies laid but couldn't afford to keep. The crash was painful, but it left something behind. AI chips don't work like that. They physically deteriorate within 1 to 3 years of intensive use. They lose their economic value almost immediately once the next generation of hardware arrives. A data center full of 3-year-old NVIDIA chips is basically scrap. But how does the crash actually happen, and what do people do? To put it simply, the AI bubble is likely to deflate over months, as more and more investors realize the AI has no long-term future. We've seen it with the dot-com era. The crash took 2 years to fully play out. Companies burned through cash quarter by quarter. Investors were unwilling to fund losses without a clear path to profit. That same thing is already visible in AI. Startups are folding. The most lucrative corners of the market, single-purpose AI agents, AI scheduling tools, and AI content generators, are all being commoditized overnight by the big model providers as soon as they prove a market exists. As one venture investor put it, every AI application startup is likely to be crushed by the rapid expansion of the companies that built the underlying models. Just look at OpenAI. Its own financial projections show deep losses through 2028. Profitability only theoretically emerges in 2030, but only if artificial general intelligence or AGI arrives on schedule. This isn't a business plan. It's a bet on a technological breakthrough that no one has proven can be achieved. If the money runs out before the breakthrough, the most likely outcome is that the big players absorb the small ones. Microsoft, Google, and Amazon didn't start with AI, and they have fallback plans upon fallback plans. They also have the balance sheets to buy up what they can't afford to let fail. The AI revolution would simply end with most AI tools converging into properties of 3 companies instead of 20. What won't be absorbed is the cost that was already distributed outward. The increased electricity bills will stay. Utility companies will have already found the next buyer and persuaded the population that that's the cost of getting electricity in 2030. As for the stock market, the investors who bought on the cusp of collapse and the failing 401k funds will be written off as investment losses. It'll be spread out across millions of people who never signed up for the bet in the first place. AI will survive the crash, but it'll be deployed more slowly, more practically, and more honestly by whoever has the capital left standing. But the gap between the world that was promised and the world that actually arrives will be paid for by the people who could afford it the least. The question isn't really whether the AI bubble will deflate. The question is who gets handed the bill and picks up the pieces. And that likely won't be OpenAI, as they'll run out of money, but not for the reason you think. To find out why, watch OpenAI is bleeding billions, ChatGPT is doomed, or click on this video instead.